Welcome back. This is a game changer. Did you miss the boat? Did you miss the pandemic housing boom where you are getting the historical mortgage rate of 3 to 4 to 5%? You may be able to do it now, 2025. This is a game changer. It is called a loan assumption. This is real. This is a strategy. And this is the beginning of a epic change in your financial life if you're willing to go through the process and if you qualify. All right, so let's dive deep into this scenario. The headline is the 3% mortgage is not debt. Assumptions surge 127% as buyers take over old loans. Look, for a long time, I knew the assumption of loans is possible. It was not practical over the years because there's no process, there's no systems, there's no procedures where someone can help us do that. But now, for whatever reason, the real estate world, the housing market, we're seeing technology, we're seeing artificial intelligence, we're seeing smarter, intelligent people are entering the real estate industry, and they are changing the way we invest in real estate. And today's situations are no different. Remember the 3 to 4% 30-year fixed rate mortgage, they're all available to us back in the historic pandemic housing boom in 2020 to 2022 this is a game changer. It could happen right now. It is called loan assumption. This information comes from ResiClub.com, actually ResiClub at analytics.com. So here it is. Some home buyers are sidestepping 6% and 7% mortgage rates by tapping into assumable mortgages. These allow buyers to take over a seller's existing loan, often look in at ultra low rates, potentially saving hundreds of even thousands of dollars per month. If you're able to accomplish this goal, you could potentially save thousands and thousands over time. This is just not a short-term deal. It's just like all the people, like 25% of the US mortgages, they have a mortgage rate of 3%. These people have a lock-in effect. Their mortgages are so attractive. They are sitting pretty. They're not moving. It's a lock-in effect. Their mortgages has become an asset, not a liability whatsoever. In a world of inflation and changing dynamics and rising housing prices, their mortgage payments are fixed at 30-year fixed rate mortgage at 3 to 4%. This is just like winning the lottery. So let's proceed as to how you and I can qualify. While most conventional loans are assumable, loans backed by the FHA, Federal Housing Administration, VA, Veteran Administration, VA loans, or USDA. By the way, I am an ex-military veteran, so I qualify to use a VA loan. So I've done numerous VA loans over my lifetime. Actually, I've done 6 VA loans over my lifetime. I'll tell you that story on another video. At the end of the day, you can only potentially, if you qualify, if you do the research, if you do the diligence, and I'll show you how in this presentation, to assume a VA loan, FHA loan, to a lesser extent USDA loan. You don't find too many of those loans. These are the only loans that are assumable at whatever rate that the seller are able to provide for you. All right, so stay tuned. Let's dive deeper. I know you guys are excited. You should be. This is a financial game changer. If certain conditions are met, of course, I'll go over the criteria, the qualification, and the conditions. Just under 1 in 6 outstanding mortgages are potentially assumable. 1 in 6, we're talking what? Less than 20%? Though they still represent a small share of total transactions, assumable sales are slowly gaining traction. Wow, exciting. According to ResiClub, U.S. Department of Housing and Urban Development, HUD, which provide us with a number of FHA insured mortgages assumed broken down by fiscal year. Back in pandemic housing boom in 2021, there were only 2,549 loans that were assumed. Then increasingly 2022, a little bit more. Then 2023, around 4,000. 2024 is like 5,861. That is 127% increase over the past 2 years and a 44% increase over the past year. You see the trend? You know what's going on? Because these type of assumable loans are potentially available to the mainstream media, whereas a few years back, it's very difficult, if not impossible, to go through the process to find this unique assumable loans once you purchase a new property. So this is truly a game changer. So let's continue. As you can see, most of these loans are FHA, some VA. I don't know the percentage, but nevertheless, they are up and coming. As you can see the trend, right? Back in 2010, they were only a mere around 600 assumable loans were transacted. As you can see by this graph, in 2024, there are 5,500. And I believe this trend, this upward almost vertical trend will increase dramatically in the next few years. So the sooner you potentially do the research and due diligence, the sooner you're able to get ahead of everybody else, because the dam is going to break. The dam is going to break. We're going to see a flood of potential assumable loans are coming into the market. So the sooner you get in, the sooner you're going to benefit from not only buying a house, buying a primary home with assumable loans, but buy an investment property potentially with the similar assumable loans at 3, 4, 5%, hopefully 3%. But there's a catch. It'll require some kind of financial commitment from you to qualify for this loan. If you're able to buy a house that will qualify for the assumable loans, but of course we have to pay the down payment. So not everybody could qualify because it requires capital. So that's the condition and that's a catch. It's no freebie. This is no freebie. Again, the challenge is as follows with assumable mortgages. Not many assumable mortgages occur because they require buy-in from both the buyer and the seller. Second, many folks in the industry don't exactly understand the process. As I told you, I knew assumable loans are available over the years, but I've been doing research for a while, but I just couldn't find a process, a system whereby you can make it work. And today, hopefully I'm going to unleash something that there are some resources available where you can make this happen. This is coming into a reality. This is real. This is not theory anymore. It has been done, okay? You can take action. You can do this. All right, so I'll tell you the resources momentarily. So stay tuned toward the back end of this presentation. It'll take longer than usual because there's so much deep dive, so much content to cover on this video. I might have to do another one. So that's 2. Number 3, the buyer must cover here it is. Here's the biggest catch. The buyer must cover the difference between the outstanding mortgage balance and the purchase price of the home. Wow. This often requires a substantial down payment. All right, so this is the catch. So pay attention. For example, if a seller has a $200,000 mortgage on a home selling for $300,000, the buyer would need to bring $100,000 to the table on top of assuming the seller's loan. However, there are options for those who can't afford, such as a large upfront payment. Buyers may take on additional debt and get a quote-unquote blended rate, which often comes out around 5%. Fred, there are some solutions for you out there. Let's continue. Most people or shocked by this, but there are actually millions of potentially assumable loans out there. Look, this is the tip of the iceberg. This is a new real estate asset class, assumable loan mortgages. If this process works, this is coming to mainstream. So if you have a strong financial position, if you want to buy a property, either a primary home or an investment property, and you have a long-term perspective, if you're able to execute, if this strategy is right for you, hey, by all means, go through the process of trying to learn this particular system and do it. All right, so let's continue. So most people, the challenge is the discovery, being able to help consumers find those homes. How you can find those homes? I'll tell you the resource. Just bear with me. The second is transparency. Nobody so far that I know of in the entire transaction have any kind of experience doing this assumption. So if you are the buyer and you want to assume the mortgage, you have to have a team to understand the whole loan assumption process. And pretty much no one are able to do that until now. You have to coordinate with your buyer's agent, seller's agent, lender, title, escrow, and closing officers. Everybody have to be involved, understand, and get educated, get up to speed about loan assumption when you're doing a particular real estate transaction that involve assumable loans. All right, here it is. There's a company, and this guy is the CEO. It's called Rome, ROAM. As you can see, it's a startup based in New York that recently raised $11.5 million in a Series A round. This is a real estate startup company. Not only could it help you find properties with assumable mortgages, but is a quote, effectively your quarterback. They are your quarterback through the process and coordinating you through the closing, according to the CEO, Mr. Singh, Raunak Singh. This is his startup company. He potentially can help you. I'll go over their website momentarily. When a seller in those states, his website listings available with sellers that have assumable loans. Again, I will do my best to show you the website to determine which areas of the country, which city, which metro where most of the assumable loans are happening. All right. So when a seller in those states lists their home for sale, Rome, this website, this consulting company, then cross-checks it with proprietary mortgage data. I don't know how they are doing it. They use technology and artificial intelligence, whatever means of necessary to provide the data. If that mortgage is eligible to be assumed, it is listed on Rome's website. Isn't that cool? And this is a sample. There are many locations. There are assumable mortgage properties spread out all over the country, but not all created the same. Look, I've been a real estate investor for more than several decades, and I help investors to buy turnkey cash flow properties, entry-level homes that can cash flow all over the country all these years. So I have a high level understanding what are the best real estate mortgages in the country to look for assumable loans. Just because it's assumable loans available from this website in California or San Francisco Bay Area or LA, it doesn't mean that you should pursue that strategy, because you may not qualify, because the median price of homes in California, for example, is like $1.5 million. The numbers doesn't make sense. So giving your financial qualifications, your income level, you have to qualify your credit and all that, how much money you make, how much of a house can you qualify for. So you have to do a lot of research and due diligence to determine what is your qualification. Unless you're making $1 million a year, yes, you may qualify to assume a loan somewhere in California. But if you make $100,000, $200,000, you have to search for a assumable mortgage in a location which is have a price point of a seller that have the assumable loan. So be careful. It come down to same thing. If you're a primary homeowner, you have to go through a loan agent to get qualified, first and foremost. If you're an investor, like I am, and many of my students that I coach over the decades, you will have to buy a property, assumable loan mortgage or not, that they can cash flow, that have a low price point, $150,000, $200,000 in the best locations in the country. Of course, I have those access, those information. This is what I do as a real estate consultant with my network, the Year Real Estate Network. You can contact me after this video if you want to talk about it in more detail to go over your situation. But anyway, Rome have many locations where you can assume the loans. Some loans are listed at 3%, some 4%, some at 5%. And then most important of all, when you dive deeper into this website, you can pretty much determine what's the loan balance versus the home value. So you know how much money you're gonna come out of your pocket to assume the loan based on the example I just shared with you. In addition to the money you need to buy your home, that particular home that have the assumable mortgage. So if you owner occupy primary home buyer, then you can buy with a FHA loan, 5% conventional loan financing, 20% down payment first and foremost, or VA loan, 0% down if you're a primary home buyer. Those are your initial down payment to buy the property itself. On top of that, you have to pay the difference between the value of the home versus the loan balance on that assumable loan. Additionally, more capital involved. So it's a double whammy. So if the spread is too much, if you have to come out of pocket to pay the difference of the assumable loan, then you may not necessarily have the capital requirement. So your goal when you analyze a particular property you want to purchase that are able to get assumption of loan, you need to have the spread between the value of the house and the loan balance itself to have a low spread. So your out of pocket to get the assumable loan is lower than the situation. Does that make sense? If you don't, just leave a comment below. There's a lot of situations. It's not that easy. You got to be somewhat savvy, somewhat sophisticated. I wouldn't say the word sophisticated. But anyway, this website, they can help you. And they only charge you 1% of the purchase price from the buyer through closing costs. So, they get paid out of the closing costs. So that's really not too much of a issue with you paying for this company who are willing to help you. This quarterback, if you will. You need a quarterback in a football terminology to help you. Most likely you cannot do this yourself because DIY, do it yourself. This is not a do it yourself business model. You had to go through this quarterback, Rome, this website consultant that can help you. All right. And of course, I can help you too, how to pick the property, run the numbers. I can coach you, guide you, become your mentor if you want, because I own properties over the years in many markets in the country, especially the Midwest and Southeast. That's the best areas to buy investment properties or even primary home for that matter. Again, I'm not going to say too much about my background, but you can learn more about it. You follow my YouTube channel or you put your email into my website so you can become a free member of my real estate investment community. We become a free member. We put your email on my website so you can, on a weekly basis, you will have access to a lot of free contents on real estate investment opportunities, buying turnkey cash flow properties in the best markets in the country, long distance, remote, regardless of where you live. Let me conclude. I don't want to spend too much time. I will do many follow-up videos for you for sure. In the future, this is a game changer. More sellers are willing to work with buyers to do an assumable loan, the CEO Singh said from Rome. Further, he says, we are seeing agents advertising Rome on their listings now because they want to differentiate their listing versus every other home in the neighborhood, because it is only home that buyers can afford. This usually pulls an additional 3 to 4 buyers listing, and the medium agent who does this goes under contract in 14 to 21 days after advertising their low rate in the listing, Singh tells RealestateClub.com. Singh, the CEO of Rome, added that an independent group of economists also studies Rome. If you enter this website, you will see the free written copy of this particular study, and found that sellers who include their low rate in their home sale netted an additional 5% on their home sales price, which can be a strong negotiation factor for listing agents when they go out to the market, when they market their home and defend their price point amid price cuts. So what this paragraph is saying is that when a seller who have assumable loan mortgage, and they disclose this information on when they put their house on sale, that their house have more attraction, will entice more buyers to potentially buy their home. So is that in a competitive landscape these days, selling a home is not that easy. They have the upper hand. So you as a buyer have an opportunity to participate, to buy these sellers, hopefully nice homes, so you can buy in a good area, in a good location that fit your goals and objectives, and able to transact. But the buyer and the seller, a motivated party, both have a lot of benefits involved. This is a long-term financial gain for you if you're able to buy a property either for primary home or as an investment home, and invest for the long term, and all the costs you pay to pay the difference between the market value of the house and the loan balance, and pay the difference out of pocket. In addition to the down payment you have to pay, but you have to calculate, do the numbers to determine whether this is a viable solution for you. This is not for everybody. Like I said, you have to have the capital available. But anyway, a lot of you have the capital available, and this kind of assumable loan scenario, it makes sense to you. All right, that's all I have to say. I'm going to produce more videos down the road. Again, with that said, I will leave you now. And if you receive any value whatsoever from this video, please like and subscribe to my YouTube channel, because I provide value for the social media out there, real value that can potentially change your financial life, whether you use the assumable loan or not. So this is what I do to help. Mainly, I help real estate investors to create wealth, generational wealth, through strategic business model of buying turnkey cash flow properties, entry-level homes, new construction homes in the best markets in the country, such as Texas, Florida, Oklahoma, Arkansas, and Alabama, just to name a few of the markets that we have a network of people to connect you with, to help you by creating a real estate portfolio, investment portfolio, to create generational wealth for you and your family. That's all I have to say. Thank you so much. Have a nice day. Bye-bye.